This is not financial advice, educational content only. Roughly 7,000 public companies file an 8K under Item 2.02, attaching a press release as Exhibit 99.1. Within minutes, wire services publish the verdict: beat by 10 cents, miss by a nickel. Tickers turn green or red, retail traders react. Most of them have never read the document that generated the headline. Here is the structural problem. An earnings beat is a comparison between one number the company chose to report and a consensus of analyst estimates that the company itself helped calibrate in the prior weeks. The beat metric, by design, tells you whether management guided analysts low enough. It says very little about whether the underlying business is better or worse than it was 90 days ago. Today I want to show you what the filing actually contains and where the information that matters is hiding. Let's look at what the filings say. The analyst consensus number that appears on every financial terminal is not independently derived. It's built on top of management guidance. Companies typically provide a forward revenue and earnings per share range at the beginning of each quarter. Analysts adjust their models off that range, layering in their own channel checks and macro assumptions. In the weeks before a quarter ends, companies sometimes refine expectations through investor conferences or pre-announcements. By the time the press release drops, the consensus has been substantially shaped by the company's own prior communications. The documented pattern, discussed across corporate governance and accounting research, is that management teams often set guidance ranges calibrated to beat, not to accurately forecast. A company internally expecting 125 in EPS may guide analysts toward a range centered closer to 115. The 10-cent beat feels like a surprise. The conversation about whether 1.25 is actually a strong result for the business gets skipped entirely. The mechanism matters because a beat in this system is not evidence of a genuine positive surprise. It's evidence of guidance discipline. That's my read. When a company reports earnings, it files an 8K under Item 2.02, results of operations and financial condition. The filing itself is usually brief, a cover page, sometimes a few lines of text, and then Exhibit 99.1e, the earnings press release. The press release is written by the Investor Relations Department, reviewed by legal, and designed to present the quarter's results in the most favorable framing available. It is not audited. SEC Regulation G requires companies to reconcile any non-GAAP measures back to GAAP in the same document, but the non-GAAP number typically leads, often in the headline paragraph. Here is the structural point: most retail investors miss the actual audited quarterly financial statements. Income statement, balance sheet, cash flow statement do not live in the 8K. They live in the 10Q, which gets filed separately, typically 3 to 6 weeks after the earnings press release. The market reacts to the press release. The 10Q, the actual regulatory disclosure with MDA and footnotes, files weeks later and is rarely read. Most large cap companies today lead with an adjusted or non-GAAP earnings figure. The exclusions vary by company but typically include some combination of stock-based compensation, amortization of acquired intangibles, restructuring charges, and items labeled as one-time. Stock-based compensation is worth pausing on. It's real economic dilution. If a company grants employees equity worth several $100 million per year, GAAP captures that compensation cost, many adjusted figures excluded entirely. A company can appear substantially more profitable on an adjusted basis than on a GAAP basis simply because the cost of retaining its workforce has been removed from the headline number. Amortization of acquired intangibles is a more legitimate debate. The argument for exclusion: it's an accounting artifact of purchase price allocation after an acquisition, the real cash left years earlier, and the amortization is a scheduled write-down of a sunk cost. The counterargument: if a company regularly pays large acquisition premiums, that amortization is a structural part of its ongoing cost profile. That's my read. SEC regulations require a full GAAP to non-GAAP reconciliation table in the same press release. That table is more informative than the adjusted headline. After the press release, the section I go to first in the 10Q is the cash flow statement, specifically the line labeled net cash provided by operating activities, also called cash from operations. The constructions start with net income, add back non-cash charges like depreciation, amortization, and stock-based compensation, then adjust for changes in working capital, accounts receivable, inventory, accounts payable, deferred revenue. That working capital adjustment is where much of the signal lies. A company reporting strong net income but generating substantially lower operating cash flow is worth interrogating. Several things can drive that GAAP accounts receivable growing faster than revenue. The company is booking sales it hasn't yet collected, inventory buildup, or deferred revenue declining as recognizing existing backlog without adding new contracted cash. None of those is automatically a problem. Seasonality and growth investment explain many of them. But directional divergence between net income and operating cash flow across several consecutive quarters left unexplained in the MD&A is something I want to understand before relying on the headline result. That's my read. Days Sales Outstanding, or DSO, is a calculation you can run from the balance sheet and income statement accounts receivable divided by revenue per day, where revenue per day is quarterly revenue divided by 90. It tells you roughly how many days on average the company takes to collect on its booked sales. If a company reports 12% revenue growth year over year while DSO expands from 42 days to 53 days over the same period, the company is booking revenue faster than it's collecting it. That can reflect legitimate structural differences. Large enterprise contracts often carry longer payment terms by design. It can also indicate that the sales team is booking deals that aren't closing cleanly. What I track DSO expanding consistently over several consecutive quarters alongside accelerating revenue growth. The accounting literature on earnings quality, drawing on the general research body here, not a specific paper, identifies this pattern as a historical precursor to revenue-related disclosures in a subset of cases. The inverse signal, deferred revenue growing, indicates cash collected ahead of recognition, which is the better quality direction. That's my read. Let me put this together. Before I care about whether a company beat by 5 cents or missed by 3, I want to answer 2 questions from the actual filing. First, does operating cash flow directionally confirm net income? Not necessarily the same magnitude. Cash from operations and net income move apart for legitimate reasons, including working capital timing and non-cash charges. But if net income rose meaningfully and operating cash flow was flat or declined for multiple quarters, I want the MD&A to explain why. An unexplained and sustained gap is a flag, not a conclusion. Second, what happened to DSO and deferred revenue over the past 2 to 3 quarters? If DSO is stable or declining and deferred revenue is growing, the revenue is collecting cleanly. If both move the wrong direction simultaneously, the headline revenue number deserves scrutiny before I treat the beat as meaningful. Neither check is definitive on its own. A company can show temporarily deteriorating cash conversion and still represent a sound underlying business. But the headline beat number, stripped of these 2 checks, carries very limited information about actual business health. That's my read. Here is the practical tool. Next earnings season, when a beat headline hits, pull the 8K on EDJAR. Exhibit 99.1 is the press release. Scroll past the non-cable to GAAP net income. Then open the 10Q 3 to 6 weeks later and go straight to cash from operations. The gap between net income and operating cash flow, explained or not in the MD&A, is more informative than the headline. This isn't advice, it's a way of looking. If the framing helped you read the next earnings release differently, that's the win. I'm Diane, back next briefing.